In this video, I'm going to give you 7 strategies that will help you trade anything, including cryptocurrencies. Throughout my trading journey, which is now about a decade long, I've had the opportunity to both read and meet a lot of different traders. Traders that trade stocks, ETFs, traders that trade Forex, traders that trade commodities. And now I've met a few traders that trade cryptocurrencies. And the thing that is common among all of them is that price matters. And because price matters, that means that supply and demand matter. And that the laws of supply and demand are the same no matter what we're trading. So right there, if you're watching this channel, then you have a leg up on pretty much everyone else that doesn't quite get it yet. You understand how chart patterns work. You understand how price and volume works. You understand how moving averages work. That gives us a huge leg up on the competition and a huge leg up on being able to be successful trading cryptocurrencies. So, rule number 1 is that everything trades the same and that the rules apply across the board. Rule number 2 is let a base develop. Just like in a stock or anything else, we need to have a solid base pattern for how we are going to trade. And what the base pattern does is that it allows the stock or the cryptocurrency to consolidate. So it would move up or move down, and then it has this sideways consolidation. It's that sideways period that allows a level of support and resistance to form. And then when it finally breaks out of that level, that's what's going to give us the opportunity to either participate on the upside or on the downside. We need to look at these patterns and let these base patterns form, and we also need to let them form for an initial coin offering as well. Just like with an initial public offering for a stock, we don't want to trade it on the first day or two that it's issued. We want to wait for some kind of a base pattern to form, and then after that base pattern forms, then we have levels to play against where we can participate in that move, whether it's going to be up or down. Number 3, we want to wait for a contraction in the price and wait for that pivotal point to develop so that way we can participate in the move. So what does that mean? So base patterns can form. So to build off of rule number 2, base patterns can form, but what really allows us to get in early, be able to profit, and be able to really skew that reward to risk ratio in our favor is going to be waiting for price to contract. And the more that price is able to contract as it forms its base from the left side to the right side is that contraction. And then as the cryptocurrency breaks out, that's what's going to give us the ability to not just make 2 or 3 times the amount that we've risked, but to be able to make 5, 10, 15 times the amount that we've risked on just a very small amount. So if a currency comes out and we are able to buy it at 100, but we would exit at 99, that's going to allow us to buy a lot more coin than if we were to, say, buy at 100 but exit down at 95 or 93 or 90. Because as the price widens between our entry point and where we plan on exiting if we're wrong and we want to cap our downside, it limits our profit potential. It limits our reward to risk. If we are going to enter and our exit is very, very close by, then that means that we could buy so much more coin and still only risk that same amount of capital. Rule number 4, you want to figure out where you're going to get out before you even enter the trade. So where are you going to exit if it moves against you? We want to know this before we enter, because just as we were talking about in rule number 3, it's going to affect how we position size. So we will be able to buy exponentially more coin if we plan on entering at 100 and we plan on exiting at 99 or 98, rather than if we plan on exiting down at 93. But it needs to make sense, and it needs to make sense on the chart itself. We need to be able to identify where support is. And the way that we'll be able to identify where support is has a lot to do with where prices traveled to before and where the current moving averages are. Where are their trend lines? That's where our technical analysis comes into play. Tip number 5, figure out how many coins you could buy based on the amount that you want to risk. So let's say you're just starting out and you have $5,000 that you want to put into cryptocurrencies. And let's say that you don't want to risk that much. Let's say you only want to risk 1% of your capital. So that doesn't mean that you'll only buy $50 worth of coin. That means that you're only risking $50 worth of coin. So if you buy at $100 and you plan on selling at 95, you will be able to buy a lot more coin than if you plan on exiting at 90. The reason why this is so important is because, like we said it in the previous rule, the more that if once we identify how much we want to risk, it affects our algorithm for how much we can buy. If we plan on exiting at 95, we could buy so much more than if we plan on exiting at 90. But again, it has to make sense, not just based on how much we want to risk, and 95 or 90 should not be arbitrary. What it should be is based on the price and volume action. Where is support? Where are the moving averages? Where are the trend lines? Figure out those things, and that will help tell you where you should be exiting. And then figuring out how much you want to risk on this idea is going to be based on your own risk tolerance. That said, we want to risk the same or a very similar amount on every single trade, so that way we are keeping our risk constant. Tip number 6. We need to know our time frames. Are we entering this particular trade as a day trade, a swing trade, an intermediate term trade, or a much longer trade where we'll be holding for a year or several years? It's so important to figure that part out before we hit that buy button. The reason why is because as the trade progresses, it's so easy to get caught up in the minutia of the day if we don't know what time frame we're trading. If we are buying a coin today and our plan is to hold it for a couple of years, then what it's doing tomorrow shouldn't matter that much. What it's doing in a week should not matter all that much. We need to trade on the time frame that we intend to trade. And when we're able to focus on the time frame that we are trading, then that filters out so much noise. One of the things that's helped me tremendously has been to separate my trading accounts. So I have separate accounts for swing trading, intermediate term trading, and longer term trading. I haven't really gotten into day trading yet, but maybe at some point down the road. But having separate accounts for each of these styles allows me to focus on one set of rules and one set of signals for each type. And that has helped me filter out so much noise and be able to focus on a set of rules for each type that I've been able to see dramatic returns in each, such as tripling the return of the S&P 500 in 2017 and doubling it in 2016. So just by following that simple strategy, it works. Tip number 7 is have a plan for when you're going to take profits. Just like we set up a plan for when we will exit with a loss, we want to have an idea of when we'll start taking off bits and pieces of the trade and exit with profits. So will we exit when we have a multiple of the amount that we've risked? So if we, going back to that earlier example, if we bought at 100 and we were planning to exit with a loss at 95, do we plan on starting to take profits at 110, 120? What kind of a gain are we looking for? What's going to tell us when it's time to exit this trade? No matter what time frame we're trading on, it's important to figure out, and not just an arbitrary number, but to figure out what kinds of offensive sell rules will force us to exit the trade or at least begin scaling out of the trade. For me personally, I enjoy scaling out of trades on the way up rather than making all or none decisions. To go back to my swing trading account, for example, what I'll do is once I make a multiple of the amount that I've risked, I'll typically take off anywhere between 25% to as much as 50% of that trade, depending on how that particular trade is working, depending on how my own portfolio performance has been, and depending on the overall health of the market and other stocks within its own industry group. A lot of the coins tend to move in a relatively similar direction, especially the larger coins like Bitcoin, like Ethereum, like Litecoin. Take a look at those charts and you'll see that they all are fairly similar, right? They're not carbon copies of one another, but they do trade fairly similarly. Same thing in the stock market. Same thing in many different markets. A lot of these things are correlated. We want to know when we will exit with a profit and need to come up with a plan. We need to come up with a plan of when we will exit with that profit. So I hope that this helps you begin to formulate your ideas of how you will create your crypto trading strategy. Let me know if this was helpful. Let me know if I missed a 8, 9, or 10 that you would include in here. Thank you all so much for watching. I truly, truly appreciate it. If you have any questions on anything I said at all, please leave it down in the comment section below and I will personally help you. Also, if you like this video, click that thumbs up button. That's always going to help us out a lot. And make sure that you subscribe to the channel so that way you get every single update. Thanks again for watching, and I'll see you again in the next video. Take care and have a great day.